A lot of people are like, well, I'm just going to get a mobile home because they're cheap. And then they look into it and they're like, bro, it's like the same as a townhouse.
Well, a lot of it's because of the lot rents.
Yes.
It's like, okay, who cares that you can get into one and it's $800 a month? Okay, but the lot's $800 or $1,000 a month.
Yes.
It's like at that point, you're almost paying $2,000 anyway.
And it's just all you
and the maintenance are more on those because they're stick builds. They're instead of using 2x4s, they're using the 1x3s or whatever they're called that are smaller. So they aren't made to last more than 50 to 60 years.
And every single thing is specialty.
Yeah.
In that.
So any repair is going to be more expensive because you have to get specialty pieces, or there's not as many contractors able or willing to work on it.
With the ADU, with the qualifying for the detached one, most of the time what I see people do, there's three main things that I see, and there's probably a couple of other obscure ways that you can kind of make it work.
These are the most common ones.
Yes. The most common ones is if you have a house where you have equity in it, you can pull out a HELOC. You leverage a HELOC to buy whatever it is, 100,000, 130,000, you're I can't remember what rates are. You're probably
like 6.5, 7.
Yeah, they're adjustable. They'll fluctuate, but I think your total overall payment is going to be close to about $900 a month or so. So if you're only renting it for 14, you're cash flowing $500 to go through all that effort.
I see people buy houses and they're like, well, who cares if I'm breaking even on rents right now? Because what's rent going to do in the next 5 or 10 years?
Right.
Like 10 years ago when I was in college, I had a private room for like $375 a month. Right. And nowadays, most of the ones when I see people posting online, $600 to $800 a month for a private room, right? In college town areas. And so it's like, oh, well, if rents have gone up 80% in the last 10 years in that department, obviously everyone else is different. You know, like condos, like 5 years ago when I got my first one, I saw most of the ones that were renting, they're renting for $1,200 to $1,300 a month. And now a lot of them are renting for $1,800 to $200. Some in Salt Lake City are like $2,300, you know, for 3-bedroom, 2-bathroom, or even 2 bedrooms.
Yeah.
And so like rents have gone up. So part of the argument I've seen that makes sense to me, which is why I like talking to someone that does it every day like you, is, oh, well, it's okay if it's only $500, $600 a month. I mean, obviously you're taking out risk by taking $100,000 of equity out of your house, which obviously you need to be good to find. You need to be in a good financial position anyways to do that. Right. Well, rents will go up and eventually that $1,400 a month will become $1,500 or $1,600 or $1,700 a month. Right.
Exactly. Like, and you can get it to grow. It's coming from a leverage perspective is more what I would say, because if you were to go, how do I put this? In a wealthier community where these things hit, like you're on an acre lot, you have a nice big house, dude, the detached ADUs, they can make sense.
4 of them.
Yeah. Well, you can't, but I would love to. California, from what I've heard, is allowing you to put multiple on one lot. But anywho, that's
totally different.
Not here nor there. So the reason behind that is because if you have the capital to do it, a lot of people just have the capital for it and they'll just pay $130,000 out the door. Yeah. They get great returns if they do that. Like totally. if you look at it like an investment property, that's freaking awesome. Yeah.
1% rule, crushing it there.
Yeah. Fantastic return. But if you have to pull out debt to do it, there's typically just better ways you could leverage the debt to make the returns.
Which makes sense. That's what we should get into. Let me quickly do an introduction, even though we're 10 minutes in the conversation. Welcome to Financial Ginger. Have you ever? Okay, so I've been thinking about this the whole time. Ever since we said the leverage part, I was thinking of what's that? Wolf of Wall Street, or no, the other one about the market crashing in 2008 and 2011. That has like all the celebrities explaining financial concepts. What's it called?
I don't know, but I know what you're talking about.
There's one where it's that one. I can't remember his name now either. But there's this part where they're like talking about just how leveraged they are, right? Because they've got like mortgage tranches and more like triple deep. And it's like, how much leverage is there on one property being sold to a bank? And they're like, oh, well, $100,000 property might have $1 million of leverage, like theoretically out there, right? Like, you know, that's how bad the loans were in 08 and 11, the way the banks were selling them. But one of the guys, like once he realizes just how bad the situation before, he's like, you know, let's go buy puts against the market or you know, short the market. He's like sitting there talking with his friends like in a strip club, right? Because that's the way they do it in those movies. He's like, we're leveraged to the tits, leveraged to the tits.
I'm jacked.
I'm jacked to the tits.
Good. Do you feel it? No.
My brain's just been saying that over and over in my head.
Just about.
Anyways, yeah. But yeah. So if you want to be leveraged to the tits, which is something I can't get out of my head right now, let's figure out with Justin Midgley the best way to be leveraged. Yeah, I'm excited. I don't even need to introduce you. Everyone will read about you. Everyone already knows who you are.
Very cool. Well, here I am.
But yes. So now that we're back to leverage, what is a better way to be leveraged? Or what are some of the best ways you can be leveraged in real estate?
Yeah, that's a question I get all of the time. And the main key factor to it is I'm going to give my corny answer first, and then I'll actually give like a more thought through answer.
Sweet.
The corny simple answer is, of course, you don't ever want to over leverage. Leverage is good when used appropriately, where people get not the shadiness, but where people have the issues with it. And when they're talking about, oh man, I bought this and I went bankrupt or whatever, it's typically because they over leveraged and they did something they shouldn't have done in the first place. Mm-hmm. Leverage when used appropriately is fantastic.
Yeah.
It's just people get impatient and they'll do bad deals because they want to just hurry up and get something moving. And that turns into bad leverage, which leaves you at risk.
Yep.
So if you don't want to be over leveraged, learn how to assess your risk and then make a smarter decision with it. Part of what I do in that same case is helping first-time home buyers purchase houses
that have ADUs.
Exactly, that have ADUs, because the way that I see it is home ownership right now is very expensive.
Very expensive.
And a lot of people look at house prices and like, dude, no freaking way.
Yeah.
Am I going to be having like some $4,000 mortgage on like a $600,000 starter home is what I get all the time from people. So the fact of the matter that I work on is you don't actually have to have that whole mortgage paid for yourself. Mm-hmm. If you were to get a basement apartment, rent out, the basement, they'll cover like 30 to 40% of your mortgage right off the bat. So for you still control and maintain an asset that's worth $600,000, but it's comparable to you buying something that costs less than $350,000.
Mm-hmm. Or this is a question that I think we've talked about once before. It's you can do it the other way around. It's like, what if you live in the basement apartment and rent out the primary, and then they're paying 60, 70% of the mortgage, and then sweet. Either way, your rent's more manageable. You're in control of it. And as your situation changes in the future, you can, we're going to move into the upstairs part and rent out the basement now. Right?
100%.
There's a lot of ways to leverage it.
I have clients, that's literally what their goal is. Like they make great money, but they're just like, we only need like 2 bedrooms. Yeah. Like we don't need some 4-bedroom house right now. So they'll just rent the top floor for like $2,500. Their mortgage is $3,500. They live in their basement for $1,000.
Which is cheaper than you can rent any basement nowadays.
Yes. And they own like a massively awesome performing asset.
They've got a backyard and they've got, right? Like, that's why I keep telling my wife is I definitely think I made that mistake a little bit because I bought a townhome and I'm like, I should have. It was right around the time you and I were meeting each other.
I was going to say, it was like right when we first got introduced.
Brought like 3 things to me and we're like, this is a great thing. And one of them I looked into and like the numbers didn't quite work. And then I made a little bit of a hasty decision, which I'm not regretting. Like, it's fine. It's just like, I recognize I could have been leveraged better. I
remember when I first met you, I remember exactly what you were doing at that point. Cause I remember I was looking through houses then at Eagle Mountain, I think. And I just remember going like, oh man, I hope he doesn't regret that one.
Yeah.
But you didn't know me well enough at the time.
And the Eagle ones did great. Lehigh one's doing fine. I'm in Spanish Fork and that's fine. Yeah. But it works like, if I had bought a different one in that Spanish, cause I paid like $420. I'm like, okay, well, wait a second. The mortgage payment's around $2,500.
Right.
But it's like, oh, wait, I could have bought a property with land, rented a basement. I deal with 2 rental properties anyways. Like, who cares to have a 3rd tenant?
Well, especially if your tenant's just right below you. Easiest thing I've ever had to manage.
If something's wrong, you just hop over there. You don't have to drive 20 minutes away.
Exactly.
Or pay a property management company, which cuts into the
profits and everything.
Yeah. And so part of me is like, part of the reason why I think this is really useful and why we've been talking, I'm like, I want to get this on is because when other people are buying, like the advice I give to everyone nowadays is talk to someone that will talk ADUs with you, right? 100%. Like just because you can afford it, you might be able to get into a better property, or like there's strategies people don't think about. So right, people don't think about that. Like, oh wait, I just see $600,000 house, $4,000 morttage payment. It's like, okay, if you're making $80,000 a year, I can't spend 50% of my money on or plus, on rental on a mortgage payment.
Yeah.
Right. It's obviously you can't do that anyways. They won't lend to you for that situation. But it's just like, oh wait, well, if you rent part of it out, it's like, oh, duh. Like people don't realize that because they don't think about that, right? That's not what we're taught to think about.
And there's 2 things that I always run into is one, when I bring this up to people, they're like, I don't want to like share my space with someone. I don't want them to be like right there. And I'm like, valid, but you're not actually sharing your space. And what would you buy instead of this? Oh, a townhome. Oh, so you're still sharing walls.
Yeah.
Like
a condo. Okay. Now you've got someone above you, below you, and beside you. It's
to the side, to the back, you got all kinds of shared
hitting
walls.
The ceiling when you're cutting your chicken at night. That's definitely not a true story that happened to me multiple times.
But yeah, and it's trying to help people understand that if you house hack properly, there is no shared space. Like I I saw my renters for the first time literally today.
And they've been living there for
like a couple.
months.
Well, these ones moved in middle of December.
Oh, wow. So it's like 4 months.
Yeah.
And you haven't even seen them.
And the only times I ever see them is when they're like, I live in a cul-de-sac. So like when their kid is like riding their little trike around the cul-de-sac.
Yeah.
But I hardly even know they exist downstairs. And that's how it's supposed to be.
Do you divide the backyard?
No.
Because I've seen some people like, oh, well, you need to divide the backyard so they have their access and you have your access. And that way you don't even see it. But I'm like, I don't feel like that's a big issue.
No. Honestly, in the contract, I just say backyard's mine.
Oh.
Like if I want the backyard, it's my backyard.
Sweet.
Like I own it.
Yeah.
So for them, with how my contract works, I'm just like, yeah, you guys can use the front yard.
Great.
And then I never even see them out there. Yeah. Most people stay inside on their phones and doom scrolling anyway.
Yeah. Guilty.
But the second thing I always run into, because there's people who are always worried about sharing the space, and that's just not the case.
Yeah, I shouldn't worry about that.
It's not roommates. You can do the roommate method. You make a lot more money. I don't
rent out each room, but you don't want to do that, especially if you're a married couple. Like that's
100%.
It's like you're a married couple, maybe you're having your first couple of kids. Okay, yeah, you want a married couple with one kid downstairs, or a couple with a dog, or a single kid that graduated college and is working in fast food. So he's got like, that's what one of my friends are. They've got a guy who works in fast food. He's gone like 80, 90 hours a week working. And he's just like, I just need somewhere to live that's within 15 minutes of the 4 restaurants he manages.
Right.
So it's like, dude, this guy's never there. He pays his thing on time. He comes home at 11 p.m. and he's gone by 5 a.m. because he's super busy.
100%.
And on the weekends, he's sleeping. So
yeah. And it's one of those things where even though you're air quotes sharing your house, it's no different than a townhome. Like it's no different. You just have an asset now that's performing in Utah's market. And that asset is worth twice as much as a townhome.
Yep.
And you're still paying less than what you would if you bought the townhome.
Yeah.
Like that's where the hack really comes in.
Well, and single family homes, I think, are going up in value quicker than townhomes and townhomes are, especially because I've noticed this. Every HOAs, right? HOAs, when those dues go up, I feel like the property values go down, right? Because people are like, oh, well, if the HOA was $200 and now it's $250 or $300, or like I had some HOAs where they were $208 when I first moved in, and now they're $300 a month, and it's only been a couple of years.
That's factored into a buyer's approval.
Yeah, exactly. Look, it's like, hey, if I have to pay $300, I need to find a way to get that off of the expected mortgage payment or whatever. Anyways,
the other thing that you'll understand as well is right now in the market, everybody's like, the buzzword that everybody's talking about is affordability, and it leads to a whole lot of virtue signaling, like, oh, we're just here to help you out. That's baloney.
Yeah.
Because that they don't actually care.
I'm here to make money.
Developers need to make money. They're not just like, oh, out of the peace of my heart, I'm just going to build cheap houses. No, they got to make money. It's a business.
We're giving 7% concessions just to be nice. No, it's because they're not moving and they've got to do something.
100%.
Yeah. And nothing wrong with that. It's business.
Yeah, 100%. But the hard thing is most of these people that have these buzzwords, all they're building right now is townhomes and condos. And you're flooding the market with one particular type of, value prop, which is townhomes and condos. So if there's thousands of them, like by your Lehigh one that we were talking about, there's literally thousands.
Oh yeah. They've built like 6 communities side by side, and there's a few single families here and there dwelled in, but
there's the super tight together, very little yards. Like they're not very appealing.
Dude, so some of them, the weirdest thing to me, sorry, I'm derailing you a little bit more. I've seen someone where like the condos are a certain size and they have to like put out an extra 6 feet on both sides to just get all the garages in. I'm like, just build the whole building 6 feet wider. Like, who cares if you give these condos an extra 80 square feet by, anyway, I don't know.
No, but you're absolutely right.
They are squeezing it.
Yes. And they're trying to just squeeze every last bit out of it because they're trying to virtue signal and cause two things is, oh, we're building affordable housing, but it's not. Like it's still $25,000 to $3,000 a month for a lot of these. Once you get past the builder incentives of like the temporary buy downs.
Oh yeah,
dude, you're still $25,000 to $3,000.
And when if rates are up in 5 years when you have to refinance.
Exactly.
You're in a terrible situation.
So like, that's why and again, that brings up the leverage. Like a lot of people, they're over leveraging into a house right now. And they're like, oh geez, I hope I get raises.
Yeah. And that's it's I hope I get raises, or I hope interest rates go down so I can refinance. I hope it's like, if not, people end up having to suddenly sell. Or I was reading an article about this lady in California who is a loan officer. Okay. Gosh. She is a loan person. She did a 5 or a 10-1 arm or something like that. Right. Wow. Because back in when she bought the house, right, in like 2003 or whatnot, it was like a 0.5% interest rate better. So it's like, well, why not? Forgot about it. Obviously, 10 years later, interest rates are way higher than the 3% they were back then, or 2.8 or whatever.
They were, right?
Whatever they were in 2003 or 2000, I don't know, whatever it was. Because this article was like dated like 2023, 2024, right? And it's like, oh, her arm expired. The rate jumped. Like her mortgage payment went up like $1,000 a month, and she couldn't refinance into a cheaper rate because rates were so much higher. It's like, well, who cares? My rate went up a whole percent. Anyways, it's a whole thing. And it's like, people sometimes get it, and that's bad leverage. That's absolutely bad leverage. The leverage needs to work in your favor to where no matter what happens, you're going to win.
Yes, exactly. Right. And that's why I preach the house hacking side so much, especially for beginning buyers, because it's when you statistics. Okay. Yeah. Let's go into data. Every about 7 years, somebody will transact. Yep. Whether that means it's a refinance, they buy or they sell, it's average about 7 years. Something happens with someone in real estate, typically.
Or quicker.
Or quicker.
I've done 5 loans in the last 5 years.
Yeah, one a year. There you go. But the benefit of having the house hacking setup is that, like, there are some people who when they go look at a house, they're like, well, my parents bought one house and they stayed there for 40 years. I need to go find my forever home.
Yes.
And it's really annoying because it's like, bro, this is not going to be your forever home. Your parents,
you moved to Tennessee.
Right. Like your parents are literally the anomaly here.
Yeah. Yeah.
And like people are going to move. So like having it in mind, it helps position them in a way where they understand it's more of an investment. Yes. And they're investing in like a retirement plan for them.
Yeah.
Like they will have a property that pays for itself, but then they get the full benefit of appreciation and the depreciation on their taxes.
Yeah.
On the whole thing, which is a much more expensive property, there's a lot more money to be made there.
And they get to fix their cost, right? Mm-hmm. Even considering like renting, it's like, okay, fine. In 20 years, if everything stays the same, rents don't go up, you're still paying only $1,000 or $1,500 or whatever, right? That math works out for your unit. Or worst case, if you're upstairs and somehow, let's be honest, this is going to happen in Utah, rents go down. Okay, worst case, you have to move into the basement, cut your mortgage and rent to someone else. And it's still cheaper.
I'm going to go crazy here. Okay. Yeah. Let's put it this way. I had some clients who their biggest concern in the world was, but what if I can't find a renter? Or what if rents drop? And I'm like, you know what? Yeah, it is a risk potentially. Definitely. I'm not going to lie to you. It's very low risk and I don't see it really happening. But here's the situation that I always tell people. You can have $100,000 set aside and you're like, I'm going to go invest in real estate. And guess what? You go buy a house, you put $100,000 down. And if you're maybe cash flowing, like, let's say $200 just for giggles, and all of a sudden rent drops by $200, you're break even on a $100,000 investment. That's not a great leverage of your money.
No.
If you bought a house though, and you have a place to live no matter what, and somebody's paying you a huge chunk of your mortgage, you only get into that house you could get in for 5% down. That's mostly what I help people do is only 5% down. Yep. So you have all of this excess money that you air quotes were able to save. But if you can't get a renter, knowing the rental market, if you were to tank rents $200 below market rate, how many applications do you think you'd get?
A lot.
Yeah. But on an annual basis, you're missing out on $2,400.
Yep.
But they're paying still like $1,500 a month on a mortgage for you. Yeah. Like that's your best return on the money that you can get. The only thing to be leery of, and this was actually the part 2. I can't remember. There was a part 1 a while ago, and then this was the part 2 for something, but we'll watch through and we'll remember what it was. It was the concerns.
Yes.
People are worried about sharing their house. And the second concern is I see a lot of people who pretend that they know about house hacking. Like they hear the buzzword, they watch like 3 YouTube videos on it, and they're just like, I'm a house hacker. I could do this. I'm an agent. I could help people house hack. Crazy thing is there's, this because it's near your neck of the woods. In Saratoga, Edge Home has a community that they're building a bunch of single family homes in. Oh. And I go to Edge Homes and I talk to the agents there and they're like, oh yeah, you could build an ADU in these easy. No, like we already have walkouts. And I'm like, really? So I looked it up. I did the research. There was 5 lots in 3 developments that fit their criteria.
Oh, that had the walkout basement and could be.
No, that hit the square footage requirements.
Oh, that's something to add an ADU.
That's something Edge didn't even understand. And then in order to get it permitted with the city, most agents will never check. And the reason I know
sometimes they're illegal ADUs and then you get fined or the government's like, you can't do this or whatever.
And they just take it away from you.
Yeah.
It's the same thing as over leveraging. It's just like, you've got to hire people who know what they're doing, because right now, when I was doing my due diligence, I found out there's like 7 people that bought their home in the last 12 months. Oh, no. City has shut them down. because there's a Karen in the neighborhood and she literally tattletaled on every single one.
And why not? If you want to live in that neighborhood and it's illegal, why not?
Yeah,
Totally.
So every single one of them, the city's been like, yeah, nope, we had to tell every single one they can't rent anymore.
Gosh.
And my client is buying a house right now. They're going to finish an ADU. The city cannot touch them at all.
Because it follows the legal rules.
Every single requirement is there.
Financial Ginger is brought to you by, well, me, the Financial Ginger. If you live in Utah and need auto or home insurance, I am your local independent advisor. I broker for nearly 25 insurance companies, which means I can shop the entire insurance market for you to make sure your rate and your coverage fit your situation and not some company quota. When you call, a real person answers the phone during business hours. No phone trees, no pressing 1, 3, or 7 just to talk to a human. Email jacobinsuresutah@gmail.com or call or text 801-216-8444 to get your quote today. Now back to the episode.
See, I was looking at that. So recently, and I've talked about this on previous episodes, I had a grandparent pass away and there's a home and my family was considering potentially keeping it or asking me to buy it instead of what I'm doing now. And I was like, oh, well, I want to double check and make sure it's even possible to rent this because I'm like, I don't want to move to that location. I'd just buy it as a rental property. And then I put tenants in the top and in the basement, refinish it, get rid of the stairs to down and make it a duplex. Well, it's not legal in Pleasant Grove to do that on that lot and that size and on that historicity and all that stuff. It's like, so I couldn't even do that. And in that area, you can't have an ADU unless it's a certain size and it's like 0.31 acres and it has to be like 0.4 something, right? So it's not close to be, it needs to be 10% larger lot and it would have to be a detached or something. Anyways, there's all these weird rules that city has.
Dude, it's so funny because you're saying that and it's speaking my language. I'm like, yeah.
Well, and to do a rental in that one that's the same building, it has to be owner occupied.
100%.
So if you move out of it, you can't put a second tenant. You can't even, because it has to be one family. Now, if you happen to be like a situation where it's like a parents and their kids being, then you're renting to one person, one party, and it's fine that but it's like, yeah, legally. No, and that you couldn't actually split. Like I was talking about sealing off the stairs. So it's actually it's like, no, you'd have to put like double doors or something. Right. Like it can't actually be fully separated. And so it's always real. I'm like, it's not worth it at that point.
No, correct.
And someone might not know that. Real estate agents need to be knowledgeable about that. And people, like you said, with that situation.
I literally had a phone call this morning.
Yeah.
Somebody in Mill Creek, they have a house. They're renting it as a duplex and it's zoned single family.
Oh, no.
And I'm just like,
you're going to have problems.
Yeah. So when they realize that, they're like, oh, well, now I just got to sell it because I don't want to handle that risk. Mm-hmm. And it's just, and I had somebody in Ogden, the city found out and shut them down. They're like, nope, you got to rent it as one unit. They've been in a battle with them for a year and a half now, trying to get it legally rezoned. Because you could get things rezoned. It's very difficult.
Yeah,
and there's
sometimes expensive.
It's mostly
maybe it's time expensive.
Very time.
If it takes you 2 years to do it,
yes.
and you already bought the property. Right. You've been missing out for 2 years.
So that's why when I go through these things, like, for example, if somebody wants to buy a house for 5-7 years, typically, if they're not going to be serial house hackers, which is the kind of like what you are, like buying one every single year, I just kind of recommend, dude, just buy a house you're comfortable with. When you move out, there's ways that you could possibly, put it into a trust and have one of the renters potentially be like a beneficiary of the trust, or you could rent it to a family member, or, there's ways that you can potentially like maneuver some of things around to like make it work. But if you're going to be a serial house hacker, just go zone to multifamily.
Yep.
Like I'm doing that with someone in West Valley right now. They're buying a duplex. And their plan is in 12 months, they're using that as rental and they're getting out of Dodge. Yeah. They're buying another one.
But it's a legally conforming.
And they'll never have to, they'll never have to worry. It's already permitted. It's already legal. It's zoned. Everything's taken care of for them. And they just kind of check the box and they move on to the next one.
Wow.
It's really cool.
Right. So that's something that I really want the listener to think about. It's like, if you're looking to buy a house in the next year or two in Utah where it's getting more expensive, it's like, think about this concept, right? Like if you can buy something that you're able to offset your mortgage by 30%, 40%, or do it the other way, rent the basement and rent at 70%. It's like that makes housing more affordable. And then as rents go up, you can switch it up, or like there's just it gives you so much more flexibility and making sure that it is legally conforming. Because sometimes it's like, fine, you can accept it. This isn't like, it's a legally conforming rental, but you can't, it has to be owner occupied. Okay, we'll just know in the future when you move, you either sell it, which is fine if you're planning to do that. And it's like, this is a starter home that I'm going to use to then buy a more permanent location. That's great. Like I've talked about this before. I have a brother who, when he moved to Maine, he kept his Utah property and he bought it in 2016.
Yeah.
Did really well, right? And when he eventually,
I was going to say that's a great one.
It's being sold. Once it's sold, he is going to pay off his property in Maine.
Yeah,
right. Like zero mortgage. right? And he's in his 30s, right? But obviously, right, 10 years has been Utah. Buying pre-2020 in Utah would have been nice for anyone.
I would love that.
Yeah, right. So it's like, you utilize that way. Not saying that you're going to pay off your mortgage in 10 years, right, and use it to buy another property. But it might be, hey, this home's gone up. I'm moving out of state for dental school or something like that. Or I'm moving here. That house is now the equity to get something that works. Or if you're stepping up to a more permanent location, if you started with something smaller that maybe, oh, I don't want to live in Santa Quinn the rest of my life. Okay, well, this is affordable. It's got the house hack ability. You can deal with that extra commute for a while. And then in a couple of years, when your income's up, you save a little more money. You're not missing out on the equity growth that's happening. And you can use that house as leverage to get into the property you want.
100%.
Or if you're able to keep it, right? Serial house market. But either way, having an ADU helps with those goals, regardless.
100%. And it just, what it does is it helps. So I did a lot of nerdy research on this. Like it was like, I literally did a report. And it was, I do a lot on social media. I legit, it took like 3 hours to do this report for one social media video because I'm like, this is something everybody's talking about. I've got to like,
I loved your whiteboard videos, by the way.
Oh, good. I'm glad. But like, I was just going through it. And I'm like, this is something I have to dispel. Like this myth I have to dispel. So I went through and I got the numbers specifically for local to Utah. For the past 50 years, on average, if you took the weighted average of income versus what it costs to own a home, we're accounting for inflation. We're accounting for the minimum wage, discrepancies, the average income. Like we're going through everything and it's weighted as if it was the same purchasing power as like today kind of a thing. Does that make sense?
Yep.
I feel like I'm not explaining it very well, but anyway,
over the past math in the description, or a link to your video or something.
I'll send you the little graph or something, but over the last like 50 years, up until about the early 2020s till now, when everything decided to go freaking berserko. On average, we're talking the average cost of groceries, the average cost of gas, the average income, the average house. Take all of that in to account. You're paying about 20 to 22%, I believe. Of your income towards your house. The last about 6 years since basically the pandemic when everything doubled and now inflation's going crazy, we're up to about 40%.
Yeah.
40 to 45%. Right. So like, yes, affordability actually has gotten worse. This is the first time in 50 years it has gotten worse.
Yep.
If you house hack though, you're literally back down to that 20%.
Yeah.
Like you literally get to buy a house at the same financial impact that your parents' bought.
Yeah.
Like that's 50 years ago.
Wow.
But now you have an asset that's twice as much. On average, for the past 25 years, we go up about 4.5% in appreciation. So I would rather be banking on having 4.5, maybe 5% appreciation on something that's $600,000 than something that's 110.
Yes.
Because now my wealth is growing exponentially, but I'm still keeping the same amount of my paycheck going towards a mortgage. Does that make sense?
Yep. The thing about percentage wise, and another way that I've thought about this that helps is contrasting home price as a multiplier of your income.
Yes.
Right. It's like, oh, hey, the average income in the 90s was like $40,000 to $50,000 or like 52, I think was when in Utah. But the average single family home price in Utah was like $105,000 or $130,000. Okay. It's like, that's about 2 to 2.3x. And now you look at the same thing. It's like, okay, average income in Utah is like 64 now. It's only gone up like 12% in the last 30 years, but the average home price now is like 530,000.
Right.
It's like, okay, it's now got to be right where it's like a 10x multiplier of the average income compared to 2.2x. So you look at that and it's like, oh, wait, there has to be a way to bridge this affordability gap. And ADUs does that. Yeah.
Yes. And the hard thing is when I did that whole report, I also took into account the average interest rate for that year.
Oh, cool.
And
so it accounts for all that too.
It accounts for the interest rates, the home prices, your income, groceries, gas. Like it really does go over all of your normal expenses, plus the price of the home, plus an average income. Yeah. And it breaks it all down. And we've been about 20% for the last like 50 years up until everything went crazy with the pandemic.
Yeah.
And now we're at 40%. Everything has gotten more expensive. You're not crazy there.
No, good.
But
no, I'm not crazy.
If you're smart, you can bring it right back.
Yeah.
And like for me in my house, like I'm easily at that point. Like when I bought my house, my current house that I live in, I've lived in this house for a few years. I bought it. It was a mid $600,000 house, roughly. I got a 7% interest rate. My mortgage was $4,300. That's a big pill to swallow.
That is a big pill to swallow.
I pay $2,300 a month.
That's less than I pay for my condo, my townhome.
And that's the magic of it. And I have a third of an acre.
And you have a yard.
I have a big yard. Like
and
it's
trees.
a third of an acre. I have a
garden.
like a 2-car garage that's almost a 4-car because it's like tandem 2 and it's like 20 feet tall. Like it is a massive garage. Like I have everything I want at this property and I'm cheaper than a townhome.
Yep.
But
do you
that's
hear
the
that?
beauty of it. Yeah. Please hear that.
Listen to that. See, that's the, I think that why I bring back to the beginning, like my mistake most recently was buying that townhome recently.
Okay.
It was fine.
You can still repent and I can help you.
Yes. But right, like when I was just house hacking and just moving from property to property,
right.
Doing the condos, those worked out fine for me. But it's like, right. Same thing. It's like, okay, I bought a $400,000 property. If I bought a $600,000 property, I could have bridged to 5%, right? Like obviously you need that higher percentage down 5%, but your net costs end up being lower.
And honestly, I'll go through this because a lot of people, they're so worried about the down payment. A lot of people think they have to have 20%. Not true.
Yeah, no,
I do like 5%, but
5.5, I think, for a first time home buyer, right?
You can, yeah. There's even first time home buyers where you could go down to 0 or 3% and still be, if 3%, you could still be conventional too.
Cool.
Fun stuff. But
I didn't know that.
In this realm, if we just did a vanilla 5%, on a $400,000 home, 5%, 20 grand. On a $600,000 home, it's 30. Like that $10,000 seems like a lot, but like you make that back in 1 year of appreciation.
Yeah.
So like it's when you're thinking about leverage, it's spending $10,000 more to get like triple that in a very short time period while somebody else is making your payment cheaper than if you put the other house.
And with the higher leverage, your not that this is a major factor in it, but it's just something my nerdy tax side wants to know. It's like you get more mortgage depreciation expense. So you get to write off more of that in your taxes too. This
year, I think my house wrote off like $45,000 of income.
Wow.
In my interest payments.
Yeah.
And the cool thing is that my tenants, because I think my principal right now is at like $600-700 a month is what I'm paying in principal. So that means I have, because I've refinanced, that means I have about like $3,300 a month that goes towards interest on my loan. But my current tenants, they're paying more than half of my dead interest.
Yeah.
It's like, I've done the numbers. It's like I bought my property for a 2% interest rate.
Yeah. Well, because that difference, you get a write-off mortgage interest expense against expenses like that. And so, that lowers your taxable income.
So freaking cool, dude. I love it.
It is cool. People don't realize how big it is. Like even if you are cash flowing, like let's assume on a rental that you're not living anymore, $3,000 more mortgage payment, $3,000 rental income. Right. It's like, it's absolutely zero. It's like, no, you're going to come ahead because of the interest expense. Like that helps your taxes. And it's 100% significant, especially when it's thousands of dollars.
You know, I'm even going to wager this because a lot of people think, house hacking, that's just for like first time home buyers. Like, this is for people who are just like, whatever. I actually have some really cool people I've helped or am currently helping house hack. I've helped attorneys, financial advisors, financial planners. I'm actually working with a guy who plays for the NFL right now.
Oh, cool.
And he's house hacking here in Utah. I'm going to look at homes with him tomorrow. And for him, it's not I make so much freaking money, I'm just going to buy whatever the heck I want. For him, it's literally, it makes so much sense that the current house he owns, he is going to lower his mortgage every month by turning that into a rental, buying a brand new like almost $1 million home, renting out his basement. He's actually dropping his monthly payments, but doubling his portfolio by house hacking.
It's like, it's amazing how much leverage it gives you and
it's
appropriate leverage.
Yeah. Like the appropriate leverage is his mortgage is going down by like $400 a month by doing this. So even if he doesn't air quotes get that renter, he tanks it $200 or whatever a month. He's going to get a renter like the next day. Yeah. People are going to be clamoring over that thing. But he's still cheaper. Like that's how you assess proper risk and you make smart financial decisions. So then with the remaining capital that you have, like think of it, instead of buying like let's say a townhome costs $3,000 a month or whatever. Yeah. And if you house hack, you got something that you're paying $2,500. That extra $500, throw that in the S&P, throw that into something, get 8-10% on your cash. Then you're not only living for cheaper, but that excess amount that you're living for cheaper with, you're just throwing it into an investment. You're literally, you can play with this money and make money like 3 times over in one investment.
Yeah.
That's how you leverage properly. And that's why I'm the biggest fan of this kind of method. So anyway, that's my thoughts.
No, I love it. I love it. That's great. I don't even know what to ask next because like my brain's just churning. It's like, oh, all these things. Yeah. I love the idea of being leveraged. Like I think it's cool, but you have to be appropriate leverage. Like some examples of inappropriate leverage. Like I've seen people be like, oh, I took my student loan money and put it in Bitcoin, you know, like things like that are just so silly and stupid. Or some people are like, oh, well, why would you ever buy a house if you can just rent? And I'm like,
oh my gosh, I could go on for days about that.
Yeah, well, obviously you got your equity and people are like, oh, well, you're going, some of it's just paying interest. I'm like, yeah, but that's still able to be used to benefit you. Interest, appreciation, the offsetting, right? Because over time, money becomes less value because of inflation. It's like that in 10 years, that mortgage payment, right? Like we never know what the economy is going to do and the way things are going to go. It's
the
like,
thing that cracks me up is since I've been on social media, I've learned that TikTok is where the most brainless people hang out. Because when I post, you should, because every time I post a video about something related to like the mortgage payments or anything like that, the comments I get is, oh, I don't want to share my house. I'm like, okay, that's just a knowledge barrier. You don't actually know what I do.
Capitalism's failed.
Yes, I get those a lot. But the other things are like, it's because they don't want to share houses. But the other thing is like, well, my rent is going to be like $500 cheaper if I rented. And I'm like, okay. And then the others is just like,
sure, but
why would I pay a high interest rate? Yeah.
What
like
if you bought 10 years ago, you're like, if I bought a house in 2017, my mortgage payment on a $600,000 equivalent property today would probably be like $1,200.
It's crazy, isn't it?
$1,200, right? That's my condo is more expensive than that now, right?
100%.
Like, that's the key is look at 10 years ago and now look 10 years in the future. Yeah. Do you think your rent's going to stay $500 cheaper than that mortgage payment would be in 10 years? No.
Right. And the hard well, especially when you house hack, because I'm helping people literally buy houses for just about what they're paying rent for.
Yeah.
Maybe a couple $100 more.
Up,
their payment goes down.
Your rent more.
Exactly. Right. And the other caveat to that as well is people are forgetting to give the proper attention to principal pay down. Yes. All they think of is they think the payment is just a dead payment pretty much because that's what rent is. Rent is 100% interest. There's no interest in it for you. It's just you're paying off somebody else's mortgage.
Paying off principal.
Yes.
And you're paying like that's so example. One of the properties that I bought, right? It was a $260,000 loan. Okay, my loan's at like $210 right now. Like right there, that's $50,000 of equity. If I was to go sell that property now, sure, right? My original loan was $270 or whatnot, you know. And I also there's appreciation because a lot of that I saw one recently in that neighborhood sell for like $305. So I'm like, okay, not only have I made $35,000 theoretically if I was to go sell, which I'm not, I'm gonna hold on to the property. I've also paid down my equity $40,000 over the last 5 years.
Yeah,
I'm like, look at that.
And that's what people don't understand is principal pay down is literally think of it as like a forced savings account.
Yes.
Because yes, you're paying $500 more a month, air quotes, if you bought a home versus just rented a normal house, right? Let's say that $500, all you're doing is you're forcing it into a savings account based in real estate. Yep. And historically, real estate has gone up. Everybody's like, oh, but what if it crashes? The only time real estate has truly crashed was 2008. That was the most recent. So everybody's feeling the burn.
And it recovered by 2010.
Yes. Everything.
And then it crashed in 2011 and it recovered before the end of 2011.
That's exactly right. Builders started going hog wild in 2015. Everybody in the pandemic thought it was going to crash like crazy. Turns out things have doubled. People have been preaching crashes happening since like 2013.
Since the dawn of time.
Literally. And I think it's just how they make themselves feel better.
Yeah.
Because like truthfully, what caused the 2008 crash, those things are not in play right now.
Yeah.
Like employment, if all of a sudden we start seeing massive drastic increases in employment, we start seeing subprime lending, we see lending criteria loosen. Yeah, we are headed for a crash 10 out of 10.
Yeah.
Like that's the indications for what led to 2008.
Yeah.
But with everything else at play right now, people are they're not appropriating the right level of risk.
Yeah.
They're thinking everything's going to just tank over time. But like you said, in 2008, the market, I actually have run the numbers, and as a average on the US national averages, 2008 crash, everything went down drastically. By about 2015, we were 100% recovered and increasing.
And more. Yeah.
But during that entire dip, guess who's still getting principal pay down? Guess who's still writing things off on their taxes?
You're still benefiting without
if you're
any
house
appreciation.
hacking, yeah, and if you're still house hacking, guess whose mortgage is still cut in half?
Yep.
Like that's even during the biggest crash of real estate in the history of all things real estate, you can still make money in great ways and not be over leveraged.
Yeah.
That's what people just don't understand. And I'm trying to help people understand that, like, if you do it right, dude, you're setting yourself up for one of the best investments you'll ever have in your entire life.
Yep, exactly. Right. And just to reiterate, 2008 to 2015, 0% net appreciation in the asset. Your $500,000 house is still worth $500,000 in 8 years' time.
Yeah.
But you still had principal pay down. You still got mortgage interest expense that you write off on your taxes, which is way more significant than you think. Like, especially now that I've got 3 properties, it's like, whoa, like
it's great.
It's huge.
Yeah.
It's very significant, right? It's like, so even with all that, and the key is you just can't be so misleveraged that if rents go down $200, you're absolutely screwed, right? That is a sign you're too leveraged. If you could not afford a small dip in rentals, and that's something that someone listening to this might say, it's like, oh, well, in Utah over the last 8 to 12 months, there has been about a 6 to 7% pullback in real estate prices, right? Like some houses that I saw, like the condos that were listed for $320 are now selling for only $305. Okay. Cool.
Again, it's condos.
Yeah. Right. Like
oversupply.
Out of that. Yeah. Right. And it's like, okay, oh, well, this and that. And it's like, okay, well, these places were renting for $2,100 and now some of them are being relisted when tenants moved out for only $2,000. I'm like, okay, if someone couldn't afford that $100 dip, that is a sign that they were too over leveraged in the property.
And it's also a sign, and this is what I try to get people to understand so much, is because if you were to go out and buy a house that has a yard and it has these other appeals, it's a different type of product.
Yeah.
It's not the same as a condo or townhome. Like,
they're more desirable, especially when you got families, and families tend to be more stable, right? If you've got a couple with 4 kids, they don't want to move. They hate moving.
It's funny. My wife and I think this is where your condo is, so you'll have to forgive me, but we call it the pit of despair.
Talking about quail?
Yeah. We call it the pit of despair because you're going down 2100 and there's like thousands of these townhomes on both sides of 2100 and they're just freaking everywhere.
Yeah.
Thousands of them. And there is no differentiation between it. Those are going to take forever to truly up the ante on their equity because there are so many options and there's so much supply that unless demand starts becoming crazy high, there's not going to be a whole lot of drive in price or rent or anything. It's going to be stagnant for quite a while is my guess. But where I'm at, it's a single family neighborhood. I've seen prices raise year over year, even through the high interest rates. I've seen things constantly rise because it's a different type of product.
Yep.
It's a more desirable product. People in a townhome, they're not like, man, I really wish I could get a bigger townhome. No, they're like, I want to get a house. I want a yard. Like, it's a different product. People are always driven to this product, which means it's a safer one to invest in anyway. People aren't always driven to townhomes.
Yeah.
They do that as every single person I've ever talked to, they buy a townhome. They're like, it's okay. I'm going to live here for a couple of years and then I'm going to use it as a rental. Yeah. And they're going to use it as a rental. They're going to cash flow. Then they're going to move out. But like, how long is it going to take someone on a $2,500 mortgage to up the rents $400 a month when there's 1,000 other people around them that are trying to do the same thing?
And I see that there's tons of that are listed for sale, listed for rent.
And it takes forever. Like every time I sell one of those condos or townhomes, I'm like, guys, I apologize. Brace yourself. It's going to take like 90 to 120 days. And the only way to get competitive, drop in price.
Drop your price $15,000.
Because they're all cookie cutter. They're all the freaking same. They're all builder quality. Like, yeah, if you did Wayne's coating on a wall, that's like a freaking $200 project that you could do over a weekend. Like, it might look pretty, but people are like, oh, I'm not spending $5,000 for that. I'm just going to go to this one that's $5,000 cheaper. Yeah. And I can just do my own Wayne's coating. Like, it's one of those things where it's a harder differentiated product. You pretty much just have to tank price or be in like one of the prime spots in the community. But most people scroll through and they just look at pictures. That's how they first see your home. They don't actually care about the community.
Yeah.
You know what I mean? Like They don't know your positioning.
Yeah.
So I don't know. That's my rant on it. I could go on forever.
People don't care about having, well, they do, but having a community pool isn't a selling point anymore.
Well, going based off of this, because this whole conversation has started with kind of leverage.
Yes.
House hacking is awesome. And what I focus on doing and what my business is built around is helping people start house hacking, but getting them to scale, because not all the time do people want to go live in a duplex or a threeplex or fourplex because.
Yeah. And they're overpriced in Utah. They're way overpriced because people know and they know that rents are. So they're like, dude, you look at like the last threeplex I looked at after I ran some of the numbers on, and I'm not an expert like you. I was like, this is $60,000 overpriced. That was my estimate of it.
But the thing is people are still going for it.
Yeah.
Because once you get into legal multifamily, you're dealing with investors who will gladly take negative cash flow because the tax incentives.
Yeah.
And they'll hold the property for like 5-10 years and they'll sell it.
They're real estate agents themselves because they can accelerate the depreciation and things like that make it even more worthwhile.
And then they keep it for the 5 years and then they just turn around, sell it, and they capture the equity. Like it's a fantastic play. They don't need the cash flow.
That's insane.
So like when I backtrack it, if people just want to do house hacking, I have them buy a really nice house that they just really enjoy.
Yep.
And then as they cut their mortgage down, they're still making money at their job. They're still saving money in other places. And when they pool up enough money, I help them do either seller finance properties. Today, I'm pulling money out of an account to throw it into a hard money loan in a hard money fund. I do nothing. Like somebody else manages it. It's funny because the property I'm investing in, I actually ran all the numbers for. So like I know the project.
Oh, that's funny.
So for me, I'm like, I'll put money in this all day. It's a 3-plex. Funny enough.
Oh, cool.
It's in Salt Lake and we're getting it for like $480 and it just appraised for $675 or something like that.
Some like repairs that need to be done?
No, it's turnkey, ready to rock.
What the heck?
Seller's just tired of it and we need to get it rezoned. But it's in an overlay where you could get it rezoned.
Yeah.
It's
Salt
just
Lake City is a lot easier than other places.
A couple of weeks of paperwork.
Vineyard doesn't care. Vineyard says, who cares? We don't need to rezone this. Like, Orem, they don't care.
But that's the beauty of it is people think in order to get into real estate investing, you have to just go out and buy these garbage properties that cash flow like $100-$200 a month. And you put $100,000 down to get barely anything back.
Or do $100,000 of renovations after you buy it.
Right. But like there's so many different things that you can do to just get your foot in the door and start being creative. It's just... You just have to have a system. And if you're over leveraged, like so many people I know are trying to do, they want to get passive income. Controversial
Real
topic.
estate's not passive. Doesn't matter how you cut it.
A controversial thing. Use this as your hook at the beginning of this or whatever. Because like honestly, passive income is the dumbest thing to focus on at this phase of your life. Yeah. It's just 100% true.
Do work.
Yes.
If unless you're in your 20s or 30s, why not? Who's not willing to do a little work?
I got off the phone with a plumbing contractor that I'm working with yesterday. It was yesterday afternoon and he had this conversation. It was my first phone call with him. And he started the call with, I just love the idea of real estate because I know it's a great place to get cash flow and a lot of passive income. And I'm like, okay, so you've watched YouTube and TikTok reels. Like that's it.
Yeah.
Because like in reality, it's not, especially in Utah. Like if you were to go out and try to buy a property, even with seller financing properties, after you account for expenses, after you account for maintenance and management, even if you manage it yourself, like whatever that is, most of these properties, sellers need cash. You're looking at $50,000 to $100,000 down. And like the magic number everybody's saying is I want a 10% cash on cash return because that's what everybody on YouTube was talking about before COVID.
Dude, that's not going to happen.
You can't find them hardly ever.
No.
But let's hypothetical here, okay? Because my NFL guy that I'm helping, I did the same example to him yesterday when I was on the phone with him. 10% cash on cash return is assuming that nothing big breaks, that you don't have any tenant issues, that you don't have to do any kind of evictions, that you don't have to do any remodeling.
Vacancies.
It's just... Let's just assume you get the magic 10%, okay? At that 10%, if you invested $1 million and you got a 10% cash on cash return,
it's $100,000.
It's $100,000 a year, which is like $8,300 a month. If you had $1 million, I would not be putting it into something for $8,300 a month. If I was looking for cash flow, there's 100 different things that you could do for cash flow. There's other benefits to real estate, which is why people invest in real estate. But if your primary focus is just like passive income, side hustle, whatever that is, it's not going to be found in real estate. Yeah. You need to create an income machine, whether that's getting promotions at your job, whether that's side hustles, side businesses, whatever that is, stockpile cash. And then once that cash is stockpiled, you buy properties.
Yeah.
It shouldn't be put everything you have into a property and like bank on that paying your bills, because I feel like it's reversed.
Yeah.
You need to build money to then invest. You don't invest to make money.
Yes.
So
I actually talked about with Sam Jones. He's a financial planner that I had early on my podcast. And he's like, look, we can talk about investment strategies and this and that and the other, but the number one and number two ways to actually build wealth is either one, cutting your expenses, right? Obviously, if you can live on $50,000 a year when you're making $100,000 a year, that's your wiggle room. If you're making $100,000 a year, who cares if you're living on $100,000 a year, you're spending it all.
Yeah,
right?
There's no way left
If you get a raise and you're going to $120 a year and you start spending $120 a year, who cares, right? So if you're able to keep your cost of living at a certain amount, everything above that. So that's the two things is you have to create a gap between your income and your expenses. And that is what builds wealth. Yeah. So I'm like, yeah. So
it's just like a business.
To build your income. It's like, those are the two things.
The thing that I've realized is that people who treat their lives like a business tend to just do better. And it's not like you have to just constantly be money hungry. Like that's such a dumb thing.
Enjoy your life.
Truthfully, that's what I think people do when they're just not good at it. And they're like, oh, well, I'm just not money hungry. It's like, no, you're just not trying. Yeah. Like it's not hard.
There's nothing wrong with it. It doesn't mean you're greedy because you're working hard. Working hard is not greed.
Right. Your gross income, like if you treat it like a business, your gross income, let's say you made $100K a year, gross income. Guess what? In a business, it counts as cost of goods sold. It costs advertising budget. It costs whatever it is. But you have housing, you have food, you have activities for your kids, vacations, whatever. Yeah. That's your spending. At the end of the year, you need to make a profit. And with that profit, you reinvest profits.
Yeah.
That's what your buddy's talking about. So treat your life like a business, but you shouldn't be investing to make money. It's you make money and you invest to be smart with it.
Because investing isn't to make money now. It shouldn't be. No. If you're investing money, that's not. That you're trying to buy a job is what you're doing.
No,
right?
Most people end up over leveraged doing that exact thing.
What you need to do is view any money you're putting in there. When I buy property, I say all money going into this is not going to give me money for at least 10 years. That's the mindset you need because it's like, okay, well, what if the dryer breaks and you're going to spend $1,000 to repair that? What if the flooring needs to be replaced, which I just had to do on my properties? That was almost $3,000, right? Like boom, 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 boom. It's like all that money, do not take that money out, right? If you're buying an investment property, any money should be staying in up to a certain limit. Like you should be doing a CapEx and realizing, hey, just because you've got money, it's like, oh, well, how frequently do you have to replace the floor? How frequently do you have to replace the roof? How frequently do you going to have to, deal with replacing appliances, flooring, all that? There's like a whole CapEx valuation, which I'm sure you do with people too.
100%.
And it's like, hey, okay, there might be a $500 cash flow each month, but guess what? You need $600 a month to account for CapEx. Now you're losing $100 a month because in 3 years you're going to have to do this. In 5 years you're going to need to replace the roof. It's like just because there's cash flow doesn't mean that's profit. That is to be reinvested in that asset for at least 5 to 10 years. And then, okay, hey, rents have gone up. Now there's some money I can take out. But that's the way you should do in any investment, right? Like when I'm putting money in the S&P 500, that isn't to make me a couple dollars a month that I'm going to spend. It's like, no, all that money's being reinvested into that asset for the next 20 years. Like that's the way investing works. So real estate should be viewed as an investment.
My big takeaway is so many people I talk to, I don't know why, like there had to have been like some kind of craze on YouTube or like this is what people's parents told them.
Said something weird or Grant Cardone said something.
Had to have. Yeah. Because so many people I talk to, they're like, I just want to be retired like when I'm about 40.
Yeah.
Like it's like the buzzword thing that happens. Everybody says, I want to be like retired when I'm about 40. I'm like, okay, great. Look at people who've retired when they're 40. Did they do it because they kept buying investment properties super young? Probably not, unless a COVID happened. And then
the people high savings rate, they had high investing rates,
and they had massive money,
or they made massive. Yeah, exactly. Those are the three things.
Yes, and that's what happens. And there's so many people on Instagram, and I tell people all the time that I'm like, guys, if they're on Instagram, they're like, hey, I'll teach you exactly what I do for this fee or whatever that is. That's their business. That's their money. Like, and then they use that to invest.
Yes.
Like it's a lot of people who try to sell that information, that's their business.
Yeah.
It's not actually what they say they have their business in. Yep. Like I know loads of very popular, well, not loads. I know of 2 very popular influencers in the real estate space. One is local to Utah. And I won't share names because I'm not gonna.
They might be on my podcast.
I might tell you after. But one of like the 2 guys, like one was recently put into fraud, like they're getting sued for fraud on crypto fraud.
Oh, dang.
And I know from other people that they are barely making ends meet. Like I know a general contractor that worked at their house and they had to keep delaying payments and doing all kinds of other crap. And like on social media, you'd have no idea. Mm-hmm. And it's because their business is to be flashy and to be like, look at me, I got all of this. And they tell a convincing story. That's how they make so much money.
Yeah.
But like, it's not, things aren't just what they appear to be. That's why
social media is all fake.
Yeah. Well,
this is
I'm
fake.
on social media. I was going to say, I'm not
real.
Fake.
We're real.
But the thing is like, unless somebody can like sit down, show me numbers and prove to me that it works, I'm going to permanently be skeptical because I've seen people, these big wholesalers or whatever, they'll sit down and they'll show numbers. Properties are fake. the stories are fake. Like I teach classes on this and I put a picture of my face next to my clients on closing with a picture of their house with their stats.
You show the numbers.
Yeah.
You show the numbers. Like I've been to some of your classes and you're like, here's my numbers on my current house, dude. And 100%. It's great. Like, here is 3 case studies from clients that actually bought these properties and what the numbers look like.
Yeah.
Right. And it's like, this is real. Right. And you're going to do the numbers on each deal. That's the thing that's nice is people are talking this and like, oh, I just don't even know where to start. I'm like, the right answer to start with is get in touch with a proper agent, get in touch with a loan officer to figure out how much you can afford or whatever, and then leverage it, and get $200,000 more by getting an ADU.
Dude, you're going to love this because I tell people who come to me because I'm on social media and I do real estate and I've worked very hard to build a really strong business. People come to me and they're like, man, I just want to retire when I'm 40. I want to get passive. They hit all these buzzwords. And there's so many times that I'm like, no, like that's not actually what you want. This is about
making it affordable.
Yeah, right. It's because here's the golden nugget is in life. If somebody pitches you something as no risk, it's super easy and it'll get you rich very quick. I would love to find that.
3 red flags of the apocalypse.
Because like the house hacking, it's not a getting you rich quick. It's cutting your expenses reliably.
Yes. It's building that gap between your expenses and your income. But it's not
sexy.
Yeah.
Like people don't look at house hacking like, well, I'm not going to retire by the time I'm 40 if I house hack once. I'm like, yeah, no, you're right. You won't. You really won't.
The point of this is to be able to afford a property at the 20% leverage that your parents had 30 years ago.
Yes.
It's about making it more affordable.
It's getting you more money that you can then invest with.
Well, that's what you said earlier. You're like, if there's a $500 gap, invest that $500. So if you're like, I'm going to have to spend 40% of my income on housing. Oh, if I do a house hack, able to get that and get to that 20% of my income level like it was 30 years ago, that frees up that cash flow for investing so I can retire.
Yeah.
Because if you do what some people are doing, over leverage themselves, sure, you might be able to afford on paper 40%, but now you're not investing to retirement. And so now not only are you house poor, you're not saving to be able to retire when you're 63, let alone 40.
Yeah. And honestly, one of the things that I've done probably 4 times this year, 2026 with my clients is they've come to me and they've been like, I want a house hack because it's smart and I want to be a serial house hacker. I want to do it every couple of years. And I send them the properties and they're just like, dude, we've thought about it. We just want to stay here for like 7 years. And like that attitude is such a different property that they buy.
Yes.
And I have actively tried to convince people to buy less expensive homes that make more financial sense.
Yeah.
Because it's not sexy. But if they want to build something, they have to build it right.
Yes.
And it's not like I'm out here pitching $1 million house hacks like, oh, instead of a $7,000 payment, only pay $5,000.
Yeah.
Like, no, it's if you're making this much money, how cool would it be if you basically got a bonus $1,500 to $2,000 a month? You know what I mean? And then you can just reinvest that into something else. Like it's repeatable. It's a securing thing for you because guess what? If you have unexpected expenses come up, just don't invest $1,500 or $2,000 that month.
Yes.
Take that money and address the situation. Like it gives you flexibility.
Yes.
And it's just,
that hit me different.
it's really cool. It's the highest value return that you can get in real estate with the least amount of money down. Everybody will preach seller financing. It's wrong. House hacking is 100% the best investment you could get on your money. And I will die on that hill because I've done the numbers for it.
Yeah. And if you have problems with that, show me numbers that are better.
Yes.
We'll make it work.
And not the fictitious, sub 2 numbers where, oh, I got into this $1 million property for $0 down. It appraised for $1.5 million. No, that didn't happen to you.
You're a trust fund baby if that happened,
dude.
Even then.
But no, like if you're an average person wanting to make it big and you don't have some massive crazy network that's going to just sell their souls to you, quite frankly, that's the way to do it. And there is no other caveat to it unless you make a crap ton of money and you're at that point where now that money is not an issue, you can start investing.
Now, you ever see someone that like buys a $400,000 house and then like 3 years later buys like a $4 million house and you're like, they hit it big.
I'm like,
their business exploded.
Are making money.
Yeah, you're making great money. Yeah.
You invested right.
Well, I want to wrap up.
Yeah.
People that are listening, they're like, wow, this is great. How do I do that with my next purchase? How can people find Justin Midgley?
I'm assuming you could just put my links in a bio or whatever
in the description. This will be in the description.
So honestly, the best way of doing that, just send me a message. I do a lot on social media, Instagram, Facebook Messenger.
Cool.
You can even comment on one of my reels or whatever that looks like. Like if you just shoot me some kind of DM,
find me.
Yeah. Like I'll find you. And what I do is I do a very calculated approach. It's not how fast can I get them to buy it?
Yeah.
That's not the goal.
I mean, you even called me like 4 times, like, hey, I found a deal. You told me this is your income. This is how much cash you're able to put down. Like this one meets that criteria, or this one's really close to that criteria. You want to look at it. Like that's what you did with me.
Yeah. And it was months.
Yeah.
And it was just like, hey, I actually found something that might work for you.
Yeah. It was great.
But there was never the pressure of like, hey, Jacob, like, dude, my mortgage is coming up. My mortgage is coming up. I really need you to buy like a $600,000. Like, no, I've built my business so I don't have to worry about that. And I just help people do what they need to do to make it work.
I love that.
So like message me, let's actually create a roadmap to get you started. And that's probably going to be the easiest way.
Sweet. Love it. Cool. We'll put links, Facebook, Instagram. We'll put all that stuff for Justin in the comments. But thank you so much for coming on. This has been awesome. I've enjoyed this because it's reaffirmed what I've been telling myself for years, even though I've been perfect about it. Because that's the thing is everyone thinks, oh, if you make one mistake, it's over. No, it's not. It just wasn't as optimal as another play you could have made. So if you want to be a little bit more optimal, get good people in your corner. Obviously, I'm the insurance agent, so I can help you insure the houses when you buy them here in Utah.
And Jacob already knows I send all my people to him. So
I was actually talking with one of them just the other day. Was it this morning you called me? No, it was yesterday you called me.
Yeah, yesterday.
We talked a little about it. So yeah, I'm excited. It's great. Thanks for coming on, Justin.